So without getting technical, a non-correlated asset is really simply an asset that has a different return and risk profile compared to another asset. An example would be stocks of companies in different business or market sectors, even more general, stocks versus bonds. Even further, marketable securities versus tangible real estate. So when you think of diversification, not putting all your eggs in one basket, having non-correlated assets are really important, because when one asset is performing poorly or is down, another asset would be performing well or is up. And so that balance really kind of smooths out the investment journey, both in the accumulation and I'd even argue probably more so in the distribution phase. Homes have always been seen as kind of this great asset to have, and they absolutely can be, and over the last few years they've certainly appreciated. But homes have what is called idiosyncratic risk, meaning that it's in a certain market, it's in a certain location, and that can be good or bad. So again, the general market could be performing really, really well, and where your home is, it's depressed, right? It's not doing well. Or conversely, kind of like in the Midwest, when the coasts were experiencing declines in the real estate values, here in the Midwest, we weren't experiencing it. So that can be good or bad, but yes, that would be an example of non-correlated asset. I would say it's an example of that. So it kind of goes back to, you want an asset that when one is performing well, the other is probably not necessarily, which you'd say, well, why don't I just have everything performing well? Well, conversely, that also is true. So you want assets that are not affected by the general market, right? They're not affected by Wall Street, as an example. Other cases, you might want them to be affected by that. So having that, again, that balance, now you're taking advantage of all different cycles, all different opportunities, different risk classes, return profiles, and so you're kind of spreading your bets across a wide portfolio of assets. You're going to want to have diversification in correlated assets. So an example of that would be, you could make an argument that different classes of stocks, so you got small caps, you've got large caps. Those have different return profiles, some cases different risk profiles, but they're somewhat correlated in the overall domestic market of companies. And so conversely, you might want to have some international exposure, because maybe international is performing better in some cases where domestic is not. You might want to add some real estate to a portfolio, because the real estate will be insulated. So it's going to be dependent on every situation. The key is to diversify both in correlated, diversify both in non-correlated, and diversify among them kind of as a combination.